So we are live. We're gonna let everybody come in. It's 1 o'clock on the hour, almost 1:01. We're gonna give everybody another 30 seconds before we get started. So appreciate everybody coming in.
Yeah, excited to have everybody here today as we kind of hit tax season. We brought some serious professionals in the craft to bear here. This is much less of a Rep Fabric conversation as much as running a business kind of conversation, and even from a really excited about today, and hope you guys get a lot of value.
Absolutely. So today we're going to talk about the tax mulligan, how a rep agency is able to reduce their past and future taxes. And we brought in some outside experts outside of Rep Fabric to bring credence and expertise to this particular discussion. So as usual, everybody's going to be on mute during this call. Please put your questions in the Q&A. We'll be answering those either as we go or at the end. Again, other stuff when it relates to Rep Fabric, you can find the LMS, and please note that everything is confidential and proprietary. So if you want to see our past webinars, please go into the LMS. You can search those there and just put in webinar, and you can see our past webinars if you're a Rep Fabric customer. If you're not a Rep Fabric customer, please send us an email and we will get you these recordings. And if you want to see where we're going to be and what we're doing next, please go to our homepage, and under resources and events and webinars, you'll see us there. We were just at NIMRA this past week. So John and I were down in Orlando, Florida, had a great time with our electrical friends. We'll be at ERA coming up here towards the end of February, and we'll be at the NAIRC Furniture Conference here at the end of February in Scottsdale. So again, we've got today the tax mulligan, and next week we'll have the MOFSI for those food service reps. I know we have plenty of people signed up there. And oh, by the way, if you weren't with us on Wednesday of this past week, we are going to have a follow-up to that session. So check the website next week for our NIMRA follow-up. So well, like I said, we'll be at ERA on February 24th at 7 a.m. We'll also be at NARC, as I mentioned before, and then we'll also be at PTRA coming up here at the end of May. So with that, I will turn it over to Mr. Vrablic. And you're on mute.
You're on mute here, John.
That picture was awful. Boy, oh boy. Hey, everybody. Thanks for having me. Hey, Rep Fabric team. Thanks for having me. Kind of getting sick of seeing you guys at all these conferences, but that's okay. It's all good. Yeah, really excited to have this opportunity. Thanks again, guys. I will introduce my strategic partner, Mike Bernardo, a few minutes into this. So he's one of our strategic partners that we work with. So he's going to help us along with this presentation, but kind of let me get started here. I'm going to share my screen, and John and Scott, just give me a heads up that you can see it.
Not yet. Now we can see it. Yep, we got you. Thank you.
All right, so we're going to talk about the tax mulligan. So I'm not a huge golfer, but I know enough about golf that sometimes you're like, geez, I wish I had another mulligan. So what we're going to talk about is 3 strategies today. 2 of them are going to be basically like a tax mulligan. You can go back and redo your taxes in prior years. So what I like to usually do is start off with kind of what are we trying to accomplish with this hour that we have together. And I really want to make sure that everyone takes away something that they can tangibly use and impact their tax planning, their financial planning. So first is we're going to review the importance of strategic tax planning. That's a very key word in this, strategic tax planning. And then we're going to talk about the benefits of 3 tax planning strategies, 2 tax mulligans and 1 tax planning strategy for 2026. So just want to review that. 2 is we're going to review the tax to death life cycle. It's a term that I came up with. It's almost like an oxymoron, tax to death life cycle. So we're going to talk about how you're taxed on your income, taxed on your growth, taxed on your growth of your investments, taxed in retirement, et cetera, et cetera. So that's the second thing we're going to review. Third is then we will review the tax mulligan strategy. So there's two strategies. One, we can quote unquote redo or take a mulligan for 2025. Obviously, no one has filed their taxes for 2025, but you probably have an estimate of what your taxes are going to be. So there's one strategy we're going to talk about that you have till September of 2026 to retroactively go back, take the mulligan, and redo what would have otherwise happened in 2025. And we're going to talk about another strategy where you can literally go back to 2023. Then we're going to talk about one planning strategy for 2026. And then this is the big one, guys and gals, is actually use the strategies to save you taxes. So one of the things that I bemoan is we go through this and everyone says, wow, that's crazy. And I'm fond of saying you don't know what you don't know. So when you see some of these planning strategies, and with Mike DiBernardo in the backdrop there's just a myriad of planning strategies, but these strategies can actually be deployed. So I would hope that, you know, when you see some of these strategies, whether it's done with us or your CPA or whoever, doing the proper tax planning, guys and gals, literally is financially changing your life purely from a financial perspective. So I really want to emphasize that whether you follow up with us or whether you get us on a call with your CPA, I really want you to think about trying to implement these strategies, because they're going to, as you'll see, they're significantly can change your financial life. So a little bit about tips for reps. So we've been specializing with reps for 25 plus years. I was at the NEMRA conference. I worked with a lot of AMAR reps on the plumbing. I've worked with PTRA reps, MOFSI reps, ERA reps. So I've been through the gamut for 25 plus years, and the company's called Tips for Reps: Tax, Investment Protection, and Succession Planning. So just a high level summary of how we do planning is there's kind of three components to it. Component number one is designing an overall plan that integrates tax, investment, protection, and succession planning. So I call that the 4 lines of discipline. And unfortunately, what I have found as rep agency owners is you're wearing a lot of hats. And unfortunately, your planning typically, not for all, but typically is very fragmented, meaning, and you're going direct. So you're going direct with your CPA, direct with your tax attorney, because basically usually what happens is, hey, Mr. CPA, how much do I owe in taxes this year? Mr. Tax Attorney or Mrs. Tax Attorney, draft me a buy-sell agreement. 401k person, give me a 401k plan. Insurance person, we need some insurance for the buy-sell. So what we have found doing this 25 plus years and working with 200 plus rep agencies over those years is it's very fragmented. So what we want to do is we want to design a plan that integrates those 4 disciplines. The second D is we want to develop strategies. So there's like I said, a myriad of strategies that we want to optimize and maximize the design of the plan. And then third D is we're going to delegate. So we're going to delegate the implementation and design of the developed strategies. And basically, if you can think through it, that's my line card, right? Your line card, everybody, is your manufacturers that you represent. My line card is the Mike DiBernardos of the world. He's our tax specialist for Tips for Reps. Well, we have a tax attorney that we have in our network. We have investment advisors. We have insurance advisors. Obviously, none of our rep agency clients are required to work with everybody, but we have the team in place, and the bench we have is pretty remarkable. So anyways, we call it planning in 3D. Design a plan, develop the strategies, delegate the implementation of it. So that's where I'll introduce Mr. DiBernardo here. So I was looking for a tax specialist for a number of years, and as fate would have it, 2.5 or 3 years ago, I was introduced to Mike DiBernardo, and he's become our tax specialist for Tips for Reps and any of our rep clients. So Mike, if you want to maybe just briefly introduce yourself and your firm, that would be great.
Absolutely. Yeah. Thank you, John. And thank you, John and Scott, for having me as well. And thank you all for watching. A little bit of background on our firm. I'm the managing partner of a CPA firm based in Southern California. We're a full service CPA firm, but our focus is on proactive tax planning, much like the ones that John and I are going to discuss today. And the way that we like to work with prospective clients is we like to work collaboratively with their existing advisors. So our goal is never to replace anybody, especially an existing CPA relationship. We would much rather work as a team and ensure that everything that we're recommending is something that your existing advisors are also on board with as well. So that's a little bit about our firm. We're planning focused, and our preference is to always work collaboratively.
Thanks, Mike.
Yeah.
And then John and Scott, I can't see if there's any questions or anything. I don't know how you guys want to handle questions, but if someone's going to chat in, it's your call whether we want to answer it or not. So
we are, John, just know we're not shy to interrupt, so we will definitely interrupt you as we go if we get questions. Keep going. You're good. You're good.
All
Let's
right.
go.
All right. So why is tax planning so important? Because it's basically, as a rep agency owner, it's one of your biggest expenses you have in running the agency. And if you think through your tax on federal, state, Social Security, Medicare tax, I mean, you could be in a 45% overall tax rate. And then every dollar saved in taxes allows you to reinvest it into your agency, employees, and your personal wealth. And so one of the problems is, and this is why Mike Bernardo and his firm are so crucial to what we do in Tips for Reps, is because most CPAs are tax preparers. If I could have a show of hands, which I can't, but if I did, and I would venture a guess that if there's 75 people on the call, probably 80% of them have CPAs that are reactive, not proactive, which drives me crazy. And typically CPAs are trained to just plug in numbers. And again, there's some great CPAs, Mike being one of them. But in general, what I have found doing this 25, 30 years is most CPAs for rep agency owners are just basically tax preparers. So there's a significant difference, everybody, between a tax preparer and a tax strategist. And then for us, tax planning is the cornerstone and foundation of all our planning with reps, because think through it, it goes tax planning. And if we can reduce taxes, save taxes, then what do we do with it? Well, let's put it maybe into some investments that we can do that are also tax preferential. And then now that we've done that, how do we protect what we've created in tax savings and investments? And then ultimately, how do we pass that on in the succession plan, not only with the business, but with your family? So I don't know, this is going to show my age. So I've titled this, by the way, I'm not only the president of Tips for Reps, but I'm also a client. Now, Scott and John, does audio play on this? If I play an audio?
Okay.
You have to share and reshare. So you have to go to share, and then when you hit share, you have to hit include sound, just so you know. So
all right, so how do I do that?
And so stop sharing and then reshare again, and there'll be a little button that says include sound when you do that. So
PowerPoint sound. So how would I do that? Sorry, guys. Should have asked.
All
oh,
right.
There it is. Good job. I've learned something today.
Yeah, I'm in technology.
That's great.
John,
so again, this is gonna show my age, everybody.
Okay, we can't see it yet.
So
let us know. Yep. Cool.
Okay.
Now we can see it. Yep.
So I titled this, by the way, I'm not only the president, but I'm also a client. So I don't know if you guys remember this commercial.
By the way, I'm not only the hair club president, but I'm also a client.
So
that's why I'm going to use a little bit of a dig on me, John.
Me too.
Well, hey, I'm losing my hair. Someone called me the silver fox the other day, so I'm gonna stick with that. Yeah, but nice. So I'm going to use me as an example, right? I'm not only the president of Tips for Reps, but I'm a client. So myself and Tips for Reps, we've actually implemented all three of these strategies that we're going to talk about today. So the three strategies are as follows. One is a cash balance plan. So think of it as a profit sharing plan on steroids. So we've done this in the past, and over the past number of years, personally, Tips for Reps and myself, we've saved roughly about $800,000 of taxes. This is one of the tax mulligans that we have, which I'll explain a little bit later, meaning that even though we're in February of 2026, we actually could retroactively go back to 2025 and take a tax deduction for 2025. So us as Tips for Reps, we did do this plan, and we saved roughly $800,000 of taxes. The second strategy we're going to talk about is a data center investment. That's where I'll let Mike explain it a little bit more. He's heavily involved in this strategy. And this is a tax mulligan where you could literally go back to 2023, 2024, or 2025 and actually amend your tax returns and receive tax credits going back as a quote unquote tax mulligan. And then the third strategy is going to be going forward. This is not a mulligan. This is for 2026 and going forward. It's called charitable gift financing. The company is called Donum, which is Latin for gift. And Mike and myself are partners. We have 2 other partners in that firm as well. And I'll explain that as well. But ultimately, for my 2025 developed strategies that I implemented for 2025. Obviously, I haven't done my tax return, but obviously working with the CPAs, Mike, et cetera, we were designing a plan to reduce my taxes for 2025. So what we did is we did the data center and we did the charitable gift financing. Now, without those strategies, when we figure out what my income was and what taxes I would pay, if I didn't do these 2 strategies, everyone, my effective tax bracket would have been 38%. That includes everything. But we designed, developed, and delegated the two strategies to reduce our effective tax rates from 38 to 3%. So let that sink in a little bit, everybody.
Come on.
38% to 3%. Now, if you look at this, I mean, this is why I said, this is literally financial. You do this for 2 or 3 years and I know a lot of rep agencies are very successful, but I mean, you're talking hundreds of thousands of dollars. So I just put this together, just a simple example. If someone earned 500,000 and they paid 38% tax, like I would have, that would be 190, 3% tax is 15,000, tax savings of 175, et cetera, et cetera. If someone was fortunate enough to earn $1 million, taking the difference between 38% to 3% would be $350,000 in your pocket. So again, if I could just emphasize as much as I can, it pains me when I go to these rep conferences and I see very successful rep agencies and I'm like, I don't have time to talk to everybody, but it's just like pains me because I know there's so many legal and ethical ways to drastically reduce your taxes. The other way to think about this though, everyone, is think about it as how does this relate to rep agency revenue? So what I have here is a tax benefit for you is not just a tax benefit or a refund. It can be equated to your overall gross commission in your agency and the additional gross commission that would be required to net you X in your bank account. So let's walk through an example. So let's assume we have a net tax defund. So we're copywriting this term. It's as funny as it may sound. No one's ever used the word defund. So we've created a tax defund. And this defund is basically the tax savings. And as an example, if we were to design, develop, and delegate a tax plan that would net the client after all fees $250,000. And let's assume this rep agency did 6.5 million of gross commission. Let's assume they had a 65% expenses, meaning their net profit was 35%. Any rep agency over 20% of net income or profit is probably pretty successful. So I'm just using 65% expenses, which means again, their net profit is 35%. We're going to assume a tax rate on those net profits of 40%. And we're going to assume this rep agency is a 50% shareholder with another owner, and the company is an S corporation. So again, practically speaking, what amount of gross commission needs to be generated so that after 65% expenses are paid, taxes of 40%, and then a 50% distribution, and it nets him or her 250,000. What is the equivalent gross commission that needs to be generated?
So this is like a 50-50 partnership is what you're saying here, right?
Correct.
Okay.
So in this example, the additional gross commissions required to net this owner using those examples, everybody, is $2,375,000. That represents a 36.5% increase in revenue. So again, at 6.5 million, there's no additional tax savings. But if the company generated another 2,375,000 after it paid its normal expenses, after it paid its taxes, after it distributed 50% to each shareholder, to net out 250,000, you would need to generate $2.3 million. So I've got here That's the equivalent of a 36.5% increase in gross commission without involving your manufacturers. So they have no say in getting on your sales trips or whatever. They're not on any of your sales trips or watching over you to create what in effect would be a $2.3 million increase in gross commission. John and Scott, is that making sense how I said that?
Sure does. It's almost unbelievable.
Yeah.
I was told there'd be no math, but other than that, yes, I'm following along.
All right, it's more dollars in your pocket, okay, Scott?
Oh, thank you. Thank you.
So here's how you figure it out. So if we had 2,375,000 of gross commission, we had expenses of 65%, which is 1,543,000. That would leave us 831,000 of net profit. If you had to pay taxes on that, that'd be 332,500. Net to distribute, which is basically the net income minus the taxes. This is the money that the two shareholders have left. That gets you to the 250. So again, just reiterating that these are like huge benefits for the rep agency clients. So want to transition into how the three strategies are going to help in the taxed on income, because you're taxed on your income. But I did want to briefly overview that this tax deduct life cycle is very confiscatory, for lack of a better way of saying it, because not only are you taxed on your income, but if you're fortunate enough to invest, then you're taxed on the growth of your investments. Then you're taxed in retirement when you start taking retirement distributions. You're taxed when you sell your agency. And we do probably 12 to 15 succession plans per year for rep agencies. We've done probably 150 of them. We've probably transitioned, I would say, $350 million of value over the past number of years, with probably a projected tax savings of 100 million or more. Because if you just do a traditional stock sale, the IRS, meaning you have a buy-sell agreement and there's $1 million stock sale, well, that $1 million stock sale is a non-deductible business expense. And so it's non-deductible to the buyer, and then it's taxable to the seller. So there's two taxes in that transaction. And the IRS is anywhere from a 46 to 52% shareholder of a traditional stock sale. If John and Scott are so nice at some point in time for me to do a special session on just succession planning, wink, wink, would love to have that. But again, you're taxed on the sale of your agency, and then you potentially could be taxed on estate taxes. So you're literally taxed to death. So with the help of our team and Mike Bernardo and his team, you literally could reduce or mitigate taxes throughout each and every tax to death life cycle. So, so here's just a short list of all the strategies. We're going to talk about the bold ones, but literally, the way I think through tax planning, everybody, is almost like a chess game. And the beauty of the chess game is we're the good guys on this side of the chess table, and the bad guys are the IRS on the other side. And the beauty of the game is we know every move they're going to make. That's called the Internal Revenue Code. We know every move they're going to make ahead of time. So all we need to do is move the chess pieces, which I would consider all these here, chess pieces that we can use, and just strategically move those chess pieces on the chessboard to get us to checkmate, which is going to be a fade to complete, because we already know.
When you say all these pieces, like every single box on here is a different chess piece. I'm just trying to follow.
Right.
Sorry.
That's exactly right. All these I would consider chess pieces.
Okay.
And sometimes in the growth cycle, we have, sometimes there's AQR here, AQR there, but all these, to your point, Scott, are all different chess pieces. And this is not even an exhaustive list, everybody. There's more. But sometimes, we move the queen. Sometimes we move the rook, et cetera, et cetera. But these are all just specific chess pieces on the chessboard to get us to the best tax position possible. Does that make sense, Scott?
Yeah, thank you.
Yeah.
And John, one thing I think is that if you do get a chance to mention some things, even from a personal taxes, because we do have some folks on here that are just, paying personal taxes. So if you've got any kind of framing for some of the advantages that someone personally can take advantage of, feel free to throw those in too.
Yeah, so this is, I mean, candidly, this is directed more towards the owners of the rep agencies.
Sure.
So the three strategies we're talking about here, one of them, no, actually, two of them can be used personally. So the first one that we're going to talk about, the cash balance plan, that's more if you're the business owner. The other two that we're going to talk about can be used even if you're not the business owner. So thanks for bringing that up.
Sure.
So the first one we're going to talk about is cash balance plan. And guys, just so I know, are we scheduled for an hour?
We are.
Okay.
Yep, we're up for an hour. Yep, keep going.
Okay. So I probably took a little bit too long on that, but here, the cash balance plan is basically what you can do this for 2025. So it's one of the only strategies where you can accrue the tax benefit for 2025, but you don't have to fund it, don't have to do anything until 2026. And again, think of it as just a profit sharing plan on steroids. So I'm going to give you an example here. So here's an example of a client who had $379,000 of disposable profit. This is an actual client. And so behind door number one, there's $379,000 of profit. And if you're a C Corp, you're going to bonus it out because you're not going to want to keep it in the C Corp. If you're an S Corp, it's going to flow to you personally. So behind door number one, $379,000 flows to you personally, and you have to pay roughly 40% in taxes. So if I'm thinking of it as a scorecard, 40% goes to the IRS, you get 60%, 0 goes to your employees. But if you did this advanced pension plan design, which is completely legal and ethical, but it is a legally discriminatory plan for the business owners. So in this particular case, we added on a profit sharing plan, and we added on what's called a cash balance defined benefit plan. When all is said and done, on $379,000, remember behind door number one, they don't do anything. 40% IRS, 60% them, 10%, 0% to the employees. In this particular case, they can fund $379,000 fully tax deductible to the company, which means they wouldn't have to bonus it out of their C Corp if they were C Corp, or it wouldn't show up on their profits on their personal tax return. So it's a $379,000 income tax deduction. And of that $379,000, $352,000 is allocated to the owners. So that's a 93% efficiency. So again, behind door number one, 40% to the IRS, 60% to you, 0% to your employees. In this particular scenario, it's 352, 93% for the owner, 7% for the employees, and 0% for the IRS. Now, we know
the employees are getting paid and you're getting paid, kind of deal.
Correct.
Right.
Correct.
Nice.
This is about the only socialist program that I would endorse because you're benefiting your employees, but all the while you're still receiving the lion's share of the 93%. So would you rather 40% go to the IRS or 7% for your employees? I think that's a good investment. So we have probably 25 to 30 of these plans with manufacturers reps, with many of them with $3-4 million sitting in their accounts that have not been taxed. And although it's a tax deferral program, it's still extremely beneficial. But with the brains of Mike Bernardo and some of our other third-party strategic advisors, we can figure out how to reduce the taxes when you take it back out. The third strategy we're going to talk about can actually make the conversion of what would otherwise be taxable completely tax-free. But nonetheless, this is a plan where you can accrue and you can take the mulligan, so to speak, and look at your 25 net income statement, call your CPA or work with us and say, geez, we have $350,000 of net income for 2025. What can we do to reduce our taxes for 2025? Well, you could do potentially this profit sharing and cash balance defined benefit plan. Now, if anyone's interested in that, all you need to do is send us an employee census with dates of birth and total compensation, and we can run some numbers for you. I would say probably 95% of the time, we're able to get a 90% or more efficiency to the business owners. And it's just a great It's a great tool because it almost forces you to invest every year, because usually what ends up happening is we'll review this with our clients. And again, we're very proactive with our clients. It's not like, I'll talk to you once a year. We need to review this on an ongoing basis. So when I usually get on the call with them and we review their net income and they say, we've got a 500,000 net income this year, they're usually not saying what's the minimum I can put in. They're usually saying what's the maximum I can put in. And the crazy thing about this plan is, think of it as a 10-year shelf life. And during those 10 years, you're able to accrue or deduct roughly $3.9 million. That's kind of the cap that you have. But when you get 2 or 3 years into this, you can start actually accelerating years 7, 8, 9, and 10 into years 3. So let me explain that. So usually the actuary every year will say, here's your target that you can fund this year, $379,000 as an example. But if you want to pre-fund years 6 and 7, you could pre-fund 6 and 7 into year 3. So I've got clients last year, a number of clients that literally for one business owner are able to do over $1 million. I was able to do over $1 million personally. I didn't do the full million, but I had the ability to do $1 million funding into this plan. Now it limits what you can do going forward, but if you're having a great year and rather than having a $400,000 net income profit, you're having $1 million for whatever reason, well, you could double up, triple up on your deductions and get the deduction for that year. So it's a very flexible plan. The traditional chassis of this type of plan it's called a defined benefit plan. And so if you think through the 2 types of plans, you've got your defined contribution plans and defined benefit plans. Defined contributions are your 401k, profit sharing, safe harbor. You're maxed out. I forget, Mike DiBerno, what that number is, like 56 or 60,000, something like that on the profit. Say that again.
Oh, they changed the limits to make it slightly higher, but yeah, it's nothing close to these plans.
So the benefit of the profit sharing plan, it's discretionary, meaning if I only had a profit sharing plan and I wanted to put 0 in, I'll put 0 in. The downside to a traditional defined benefit plan is you can do 316 into the plan here in the green. And traditionally, you're kind of stuck on that. If you put it in for 1 year, you got to put it in for every year. But what they've done is they've combined the benefits of a profit sharing plan, i.e. the discretionary opportunity, with the traditional defined benefit plan, which is maximum tax deductions. And they've combined it into 2. So now with the cash balance plan, it's very flexible. And I'll give you a personal example. So in 2023 tax year, or 2022, I forget. Let's assume it was 2022 tax year. It was March of 2023. So remember, I can pick a mulligan and go back to 2022. So I had 5 kids. I still have 5 kids. 5 kids, all of them going to private school. I called the actuary. I said, hey, Brian, forget it. I'm going to put the minimum amount in, which was 0, which is, again, gives you the opportunity to be very flexible. I could do 0. So he said, yep, you can do 0. And then when I saw what my tax bill was going to be a few months later in August of 2023, I called the actuary up again. I said, max it out. What's the max I could put? And I robbed Peter to pay Paul. But for every dollar I put into the plan, it was a 45% savings. And the reason why I bring that up is exclusively to show you that it's extremely flexible. You can put the minimum, you can put the maximum. And as long as you file an extension on your tax returns, you have till September of, in this particular case, you have right now up until September of 2026 to take the deduction for 2025.
John, with the succession planning work that you do, how does that influence, a succession plan here? Is the company accruing this plan in such a way that the future owners have more tax liability or less liability?
Right. So I did not plant that, everybody. John actually intuitively asked that question. So
trying to help
right
everybody.
Now, right now, the way I'm reviewing this, everyone, is purely from a personal planning. I'm a business owner. I have $379,000 of discretionary profits. what's the best strategy for me to use personally. But to John's point, a lot of times what we'll do is we'll incorporate this into an overall buyout. So without getting too complicated, let's assume there was two owners, and one of the owners is 50 and one of the owners is 60. And the one that's 60 is going to retire in 3 or 4 years. So what we could do is we could say, listen, if both of you wanted to fund the cash balance plan, it would be a 500,000, 250,000 each as an example. But what if at the end of the year, we only funded the 60-year-old at 250, and the 50-year-old did not get a contribution into the plan? So what we would do is we would say, listen, every time we do that $250,000 that I didn't get a contribution on, that's going to go towards your future buyout. So what that means is it's tax deductible. You're pre-funding the future buyout on a tax deductible basis because the $250,000 is a deductible expense. And then that $250 then is a prepayment on the owner's future exit. And that $250 in my example, there's no taxes on that. So you basically created a tax deductible pre-funding mechanism with a tax deferred vehicle that if you do that over the next 3 or 4 years, I'm thinking of an EERA rep where it was that exact example. It was $2.5 million that was owed to the exiting owner, and we funded the entire $2.5 million with the cash balance plan, meaning the buyer got 100% deduction on the $2.5 million, and the owner has not paid any taxes on that yet. So thanks, John, for asking that question. Did I answer that okay?
Yeah, great. I think everybody understood that. That's cool.
Okay. So that's the first mulligan. The second one is the data center. So I'm going to have Mike chime in here because I've hugged the microphone here for too long. So I'm going to have Mike Bernardo explain the data center investment. And there's looking at it from two perspectives. There's a financial and tax benefit, and then there's tax legislation for what's called bonus depreciation and tax credits. So Mike, I'm going to stop sharing my screen, and I'm going to have you take over on this. And if you could talk through how we can do it as a mulligan and or how we can do it going forward, that would be great.
Absolutely. Yeah. Thank you, John. Awesome. Well, so as John mentioned, the investment involves data centers, and I'm sure everybody on the call has probably heard of the AI boom and the data center craze, and many of you probably have experienced it in contracts that you're winning too. And one of the biggest deficiencies in this boom is electricity. And so what we're actually investing in addition to the data center, is power infrastructure. And the reason that that's important is because there are two pieces of legislation that turn this from really a financial investment only and into both a financial and a tax investment. And those two pieces of legislation were the Inflation Reduction Act and the One Big Beautiful Bill. So what the Inflation Reduction Act did is it created ITC credits, which are investment tax credits, that are not only usable but are transferable.
Hey, Michael, are you sharing your screen? Just so we.
Not yet. Sorry, I'll
okay,
share my
that's
screen.
Good. All right. Thanks.
In a few moments. Yep. But thank you for checking, Scott. So it creates tax credits that are both usable and shareable, and those tax credits exist primarily for clean energy infrastructure. So think of solar, geothermal, wind, battery storage, natural gas. All of those produce these tax credits. And where that becomes valuable is that if you're planning on using the credits, you can actually carry those back for up to 3 years. And so right now we're in the 2026 tax year. That means we can carry back these credits all the way back to 2023. And the value of a credit is that it's a dollar for dollar reduction in federal tax. So unlike a deduction, which is a dollar for dollar reduction in income, a tax credit is a dollar for dollar reduction in tax. So by way of example, if you had $1 million of income, and let's say that equates to $285,000 in federal tax, you would only need $285,000 in tax credits to eliminate that tax, as opposed to $1 million in deductions to eliminate the tax. So credit is always more valuable than a deduction. And I'll go ahead and share my screen here so we can really put some numbers to what this opportunity looks like. So as I mentioned, with this investment, we're investing in power infrastructure, which produces these credits. And we have the two options. We can either use the credits or we can sell the credits. I'm going to start with the example of using the credits because that's where the mulligan comes in, and then we'll show the example of selling the credits because that could be just as beneficial, but that would be for a present year tax savings. So if we were to use the credits, every dollar invested in this particular program produces credits that are equal to 85% of the investment. And so what I started off here was with an example of a $350,000 investment. And then I'll also show a side-by-side comparison of what that tax strategy would look like for someone with $1 million of income. So a $350,000 investment would produce tax credits equal to roughly 285 to 297,000 in tax credits, and those are credits that you can use on your tax return.
That's the just in the green, that 297 there. Maybe you can point to it, Mike.
Yeah, right there. That 297,000.
Got it.
Is produced from a $350,000 investment, and the reason for that is that this $350,000 investment is going towards installing solar, geothermal, and battery storage energy on a campus that houses a data center. And the idea is that those the energy produced by that infrastructure will power the data center. But that infrastructure produces these credits. And if we were to make this investment, say, this year in 2026, we have the option of carrying back these credits to a prior tax year. So what I also have prepared is a sample of what that would look like for someone who's made $1 million of income and wants to carry those credits back. So in this case, in 2025, this person made $1 million, and they had they would have had federal tax of $282,000, possibly a little bit higher. I'm going a little bit conservative here. We've factored in some additional deductions and things like that are pretty standard. So on $1 million of income, you'd have roughly $282,000 in federal tax. That $350,000 investment, assuming it produced $285,000 in credits on the low end, would completely eliminate your federal income tax. And you could see that difference here, that investment would have saved you $282,000. A $350,000 investment would have immediately saved you $282,000 in federal tax that you carry back to 2025.
So if I can interject, yep. Usually everybody, just so you know, and I'm not just saying this as a sales guy, but I always hear clients when I talk about the other tax strategy, too good to be true. When Mike Bernardo shared this movie, I said this is too good to be true because the 350, everyone, is actually an investment. So it's not like you've sent out 350 and you don't have you have a $350,000 asset that actually is going to produce income, which Mike will go through. So not only do you get to recoup the taxes or apply them to 2026 if you want to, but you actually have an investment. And again, this is one of the strategies that I incorporated for the 2025 tax year that took me to that 3% net effective tax bracket. Sorry, go ahead, Mike.
Oh, no problem. Yeah, and I should mention I also did this for my own personal tax planning as well. So both John and I are users of this strategy as well. And so as John mentioned, this $350,000. It's also an investment. So immediately it saves you the $285,000, but you still have that $350,000 that's invested. That's going to produce a rate of return for you. And where that return comes from is selling the power to the data center. And the amount of the return is going to vary based off of the users of the data center. So if we had little to no users on the data center. We model that here in kind of our potential worst case outcome. And in that case, what we would do is we would actually just sell the power back to the utility company. So these projects are located in sites where we can interconnect to the grid and sell to the utility company if we don't have an off-taker on the data center, which would still produce cash flow for us. And even in that case, on a $350,000 investment, we're looking at a net after-tax return of about $22,000 a year. So not bad. It's almost a 7% rate of return after tax on that $350,000 investment. But remember, it already saved you $285,000 in tax immediately. So really, if you back out what your actual investment was, you're at $65,000 investment effectively, producing around $23,000 a year in after-tax income.
That's more like a 40. It's more like a 40% rate of return.
Yeah, when you look at it that way, it's a much higher rate of return.
Right.
But then that's just on the low end. That's just if we're selling the power to the utility companies. If instead we have users of the data center, the returns could be much higher, because in that case we're going to be selling the power to those users, and they're going to pay a much higher rate per watt than the utility companies would. And to just give you a sense of what the disparity in the rate is, the utility companies maybe going to pay 0.7 cents per watt, whereas an actual user of the data center could pay as high as 22 cents per watt. So if we're looking at that 22 cents per watt scenario, you can see that the rate of return on that same investment, or the cash flow produced on that same investment, goes from 22 to 23,000 a year up to 100,000 a year. And remember, that's on a $350,000 investment, but if you factor in the cash flows, that's really a $65,000 investment that could produce as much as 100,000 a year. So
Mike,
these tax credits really create this too good to be true feeling.
Mike, this seems like cheating. It seems like cheating. I'm like, what?
It's the chess game.
It's
the chess game.
amazing.
We know the credits we're allowed to get.
Yep.
We know how much we need to invest, and this is one of the chess pieces that we'll call this the queen.
Yep. And it's exactly right that it feels like cheating, and it's entirely because the government's behind this, effectively backing it with these tax credits.
And guys, I'm sorry. So whenever we do tax planning, it's never like wink, wink. I hope the IRS doesn't look at it. No, this is the IRS has approved. This is like hitting it down the fairway, everybody.
Yeah, they're encouraging you to do it. They're encouraging you to.
Yeah, exactly. Congress wanted people to make these investments. They need people to make these investments because we have an energy shortage, or we will have an energy shortage with all of the demand from the data centers that's projected.
It's all John Mitchell's AI. That's the problem.
Yeah. And so that's the mulligan aspect of this investment, which is still great, but as you can see with these numbers, you're still at risk, right? You're still at risk, even that 65,000 that you put down, right? So you have the 350,000 in, you get the 285,000 in credits. You're still at risk that 65,000. So this is still something where, of course, there carries investment risk. But there's another way to do this where the tax savings could be even higher than the amount of cash that you have to put down. And I'm going to modify the model to show what that looks like. And I'm going to use the million as I'm going to use $1 million of income as an example, and show you what this looks like. So we're still using the same million, but we're going to go the other way. Rather than using the tax credits to offset the tax, we're going to use bonus depreciation to offset the tax. So one thing I probably should have mentioned at the start was that this power infrastructure not only produces tax credits, but it also produces bonus depreciation. And if we go the bonus depreciation route, we can actually further mitigate the investment risk associated with this investment and put you in a position where you're going to get an ROI just from the tax attributes. And the way we would do that is, if we recall from the start of the conversation, these credits are not just usable, they're transferable. And what that means is that I can go and sell these credits to a third party so that they can use the credits to offset their taxes. And there's a tax credit market for this. That market is it's about 500 billion a year is the market for these credits, and there's really only a supply of about 50 billion of credits per year. So there's significant demand that outstrips the supply. And the group that puts this investment together, if you decide to sell the credits, they will sell them for you. You don't have to worry about doing this. But if they sell the credits, that's actually tax-free income to you. And this was all part of the Inflation Reduction Act that made the proceeds from the sale of those credits tax-free income. And so what the group that puts this program together is able to do is they're able to say, well, what if we reverse leverage this? What if we say that the investor who's going to make $1 million investment, what if they told us going into it that we can sell the credits from day one? In that case, what we can do is we can offer leverage for the program that's virtually risk-free. And what that means is that because those tax credits are roughly 80 to 85% of the investment amount, it means that on $1 million investment, we know that we're going to get, on the low end, 800,000 from the sale of these tax credits. And so if that's the case, we can use that 800,000 as part of the contribution to pay for this investment, so that the investor only has to put down 200,000. And they do this on the front end. So essentially for 200,000 down, or 20% on that million, it would always just be 20% would be the amount down. They would give you credit for $1 million investment because they know that they're going to be able to sell the tax credits.
And $1 million bonus depreciation.
Yep. And that $1 million investment gives you $1 million of bonus depreciation. And so what that looks like for the same scenario, now we can't go back, we can only do it for the present year. So this is why we have 2026 here instead of 2025. But for that same $1 million of income, which was also shown here, you could save that 282,000 in tax by just putting 200,000 down. So the difference here is by doing this for the present year, as opposed to having to go back to the previous years, the tax savings are going to be more than your cash outlay. You only had to put down 200,000 to save 282,000 in tax, and you still get the cash flows associated with that $1 million investment, which only cost you 200,000. And so that's where the benefit of this could come in, doing it in the present year. But of course, we understand that there's the need to go back in prior years, and so you could do that as well. And so this strategy is very flexible. And sorry, I tried to go through that pretty quickly, but if anybody's interested in this, John and I are happy to do private consultation on what that actually looks like for your personal situation, how we would structure that so that you get the maximal use for it, whether you want to carry it back or use it in the present year. But I'll pause there for any questions before we move on to that third strategy, the Donum strategy.
Yeah, so just we only have a few minutes left. So yeah, if you want to move ahead to the third one, I'm monitoring the Q&A and haven't seen anything yet. So please keep going.
Great, okay. That sounds good. John, I don't know if you wanted to. I'm going to pass it back.
Yep, I got it. Thanks, amigo. Okay, so we're going to go through this because that's what Mike went through. The last one is called a charitable financing strategy. This is Mike and myself are partners in this, and then we have two other partners. So we call it the Donum plan. And again, these are just chess pieces, and it doesn't mean you're going to use all three. There's another 8 or 10 that we can use. I'm just using the example that in our particular case, we did do the cash balance plan, which saved us 800,000. And we did do the data center, and we did do the Donum, which took us from 38% effective to 3%. So again, if you think through the tax to death life cycle and all these chess pieces, so let's use the cash balance plan as an example. If you remember, that cash balance plan had a $379,000 cash balance or total tax deductible. In that particular case, that represented 23 or 24% of the client's income. He was making about $1.5 million. Well, that means he's only able to get a 20 to 23% income tax deduction each year. But this strategy, the Donum strategy, can get you up to a 60% income tax deduction. So if you think through these, the data center is potentially 100%, so that's great. And we might be able to exhaust all the planning with just the data center, but facts and circumstances a lot, might have us use a different chess piece. So this is just another chess piece. So under Section 170 of the Internal Revenue Code, you're able to make a charitable deduction or a charitable contribution of up to 60% of your income, which is a great strategy because it's much better than the cash balance plan. So let's walk through an example here. So I'm gonna title this client, and the client's name is going to be Mr. and Mrs. Phil Anthropy. I thought that was funny. So this is charitably inclined. We're utilizing the charitable deduction code of Internal Revenue Code 170. So Mr. and Mrs. Phil Anthropy, they are making $1 million a year, and they're eligible for a 60% income tax deduction on making a charitable contribution. So that would be huge to be able to get a 60% income tax deduction. But the problem is we got a little detour here, and that detour is called taxes. So I don't know if you guys can see this, but one of my partners at Donum sent this to me. And if you can see it, there's a mask here, and this is not an eagle, it's a vulture. And it says, we have what it takes to take what you have. That's the IRS. So the problem is this client's tax deduct. And on $1 million of income, after paying taxes, there's just not enough cash flow for them to make a $600,000 charitable donation. Remember how Mike talked about using leverage in the data center? Very similar concept. People finance a data center, people finance a home, people finance an investment, et cetera, et cetera. What if you could finance a charitable donation? So that's where we come in. So the solution is we have a third-party lender that we've partnered with. It's funny. It's actually funny because you guys and gals are all reps. We have literally an exclusive rep contract to do this, not only in the US, but literally over the entire world. So we have a third-party lender that we've contracted with that will finance the $600,000 donation. So what they would do is they would lend you under a financed loan, or lend Mr. and Mrs. Philanthropy $600,000. They receive $600,000 in cash, and then they donate the $600,000 to a 501c3 charity that aligns with their values. Well, they're going to get a $600,000 gift receipt. That means they're going to get a $600,000 tax deduction. There are no payments on the loan. It is fully non-recourse, which means the only recourse that the lender has is a life insurance policy that they take out on you. That's a part of all the fees associated with it, which I'll explain in a second. There's basically a 4-to-1 ratio. For every dollar that you take as a finance loan, you for every cost that you pay, for every dollar you pay in fees, you get a $4 income tax deduction. Very similar to the data center. So it's fully collateralized by the life insurance death benefit. It's only due upon death. No interest payments, no principal payments, because it's fully collateralized by the death benefit. All of that is encapsulated in the fee associated with the plan. So let me walk you through an example. So I know we're running up.
Yeah, we're right up against it, just so you know.
Yeah. So I texted John if it's still okay, if I can go 5 more minutes. Is that okay, everybody? Because I think I can finish this up in about 5 minutes. Scott, is that okay?
Yep, keep going. Go.
Okay. So I'm going to call this BC, before conversion. You have a client makes $1 million. Federal taxes, state taxes are going to pay $370,000 of taxes. Under scenario 2, they could, if they wanted to, give $600,000 as a contribution, which would significantly reduce their taxes from 37% to 11%. But the problem is, in order to get a $600,000 charitable deduction in the normal sense, you'd have to fund $600,000. So now they're only left with $287,000. This is where we come in. We can finance the $600,000, still save $258,000 of taxes. So again, the $600,000 charitable deduction We lend you 600,000. You take the 600,000, make the donation to the 501c3. You get a gift receipt, give it to your CPA. You get the deduction of 600,000. That equates to, in this particular instance, $258,194 as a what I'm going to call a gross tax defund. We've defunded the IRS 258. The all-in fees, similar to the data center, was 20%. This is 25%. This 25% covers everything. Covers you not having to pay the loan back, interest, covers the insurance. So the net cash flow, if they don't do anything, BC, I call AD after Donum, is an extra $108,000. So by doing this strategy, the client would, or you as a rep agency owner, would net $108,000 in your pocket. So there's a few ways to look at the financial benefits of this. One is as a pure investment. So if you look at it as an investment, and you know everyone has investment advisors. So if your investment advisor came up to you and said, "Hey, Mr. Rep client, I've got an investment for you. If you invest $150,000, come April of 2027, your account's going to be worth $258,000." So what that means is the collateral cost all in is 25% on 600,000, which is $150,000. So that's quote unquote an investment that you made. But come April of 2027, you're going to get a tax defund of $258,000. What is that in the equivalent of a rate of return? So if you invest $150,000 in a normal investment, and then you would have $258,000 within a year, what do you need to return as an investment? Because the gain on that is 108. You invested 150, you have 258, your net gain is $108,000. So what is that as a rate of return? 72%. And that's 72%, making the assumption that we're taking your federal tax rate properly, your state tax properly, and we're figuring it out, and we coordinate this with your CPA to make sure that the numbers are all, that's basically a guaranteed 72% rate of return. In other words, collateral cost is 150, you get 258 back from the government or a defund, that rate of return is the equivalent of 72%. So that's pretty good. If I was an investment advisor and I could tell all my clients they could make 72%, I might not be, we only started this a year and a half ago. I might not be sitting in Tampa here. But if you compare it, so thinking that comparing it as a traditional investment, potentially anywhere from 60 to 80% rate of return on your capital, depending on what state you're in. If you look at it as a loan, a traditional loan, and I'll be done in 2 minutes here, guys. A traditional loan, you got to put 20% down, which is 120, but you have to pay interest and principal payments. So that I'm assuming a 15-year mortgage or a 15-year loan, you would have had to pay $926,000 on that loan. In ours, 600,000 is 25% collateral, which is 150. The interest rate on the loan accrues at 4.5%, but it's 100% covered by the insurance death benefit, which you do not have to pay, and you don't have to pay any principal or interest payments. So there are no principal or interest payments to get the $108,000 defund. And then the other applications to this Donum plan is, think of having an IRA and you're kind of stuck with that. So the cash balance plan is great, but at some point in time, you're going to have to pay the piper. So what you can do is, let's say you roll money out of the cash balance plan, you have $1 million in IRAs. Well, that's the most confiscatory asset you can own because it's going to be subject to income tax and potentially estate tax as well. So what you could do is you could convert the $1 million IRA. That would increase your income by 1 million, but then you would get a Donum financed charitable deduction of $1 million. There'd be zero taxes on it. So that's a huge opportunity, I think, for clients. And then you can use it for estate planning as well. So again, wanted to go over those 3 strategies. The two of them, cash balance plan and the data center, are quote unquote mulligans. On the data center, I'm probably in line with Mike Bernardo. That's probably more efficient to do for 2026 planning. But if someone had a huge realization event in 23 or 24, you can get the tax credits and go back. So again, the goal of the webinar was wanted to emphasize how important this was. and how significant tax planning is. Review the tax to death life cycle. We did that. We reviewed the tax mulligans. We reviewed the Donum strategy, which is another chess piece on the chessboard that we have. And again, want to emphasize, these are strategies that you can actually implement. This is not, I'm not going to say these aren't necessarily somewhat complicated, but that's where Mike and myself come in, and we review it with your CPAs to make sure that everybody's on the same page. And, you know, we would never want you to do any of these planning strategies without confirming it up with any of your other advisors that you have. But these are strategies that, in a real life example, takes me from a 38% federal tax bracket to a 3% tax bracket. And with that, I'm 6 minutes over.
Awesome. Thank you, John. We appreciate it. And Mike, thank you very much. Awesome stuff here. And guys, for those who are still on, we're going to put this on the LMS so you guys can reference it later. But just want to say thank you very much to Mike.
Thank you.
And to John for being on with us. So John Mitchell, any closing thoughts here?
No, yeah. I mean, and I'm trying to pick my jaw up off the floor. I feel like it's almost science fiction. But you know, I guess it does, you know, it does make sense in terms of the investments, as you point out, with the AI data center build outs and the investment that we as a country, or, you know, as the Western world are making into it. And so with that, I also want to, you know, sincerely thank you guys. Your expertise is certainly, I know our groups are going to find very, very valuable, and we recommend that they reach out to you directly. What's the best way to do that? Do you guys want
it would
to?
It would be an email. I don't know if you guys can send an email, my email address out, and then I'll make sure. Yeah, if you can send out the email address for me, and then I'll connect us with Mike.
And you know, one last thing is that I know it sounds like, you know, John and Michael, you guys spent a lot of time reading the legislation that passed to find these little situations, right? And you know, so for the next piece of legislation, I'm sure you'll be doing the same thing. So I think as a long-term planning and advisors, you know, it's fascinating what you do, and I just want to thank you once again. So
yeah, thank you so much.
Absolutely.
Looking forward to it.
Hey,
thanks everybody.
Quick plug, follow us on LinkedIn. Make sure you see John up here, and we'll answer any questions we have going forward. So thank you so much. Have a great afternoon.
Hey,
great weekend.
Scott, can you say, I got one question for you, Scott, if you can stay, I don't know if you can stay on, or you have to completely.
I got to jump. I'll call you though. Yeah.
Okay, give me a call.
Cool. Thanks, guys.
Thanks,
Appreciate
guys.
you.
Take care.
Bye.
Thanks. Bye.